Okay, the evolution of money. Let's walk through how and why money has changed over time. Here is a very high level overview, some of those major changes that have occurred in what we've used as money. Now, we're not going to get too bogged down in the specifics of the timeline, but we will look at a few key events that help explain why those changes have occurred. Let's start with primitive money. So these are things like tools, collectibles, commodities. There's a great essay by Nick Szabo called Shelling Out the Origins of Money. I'll link to it below and I'll just read a brief quote from that essay. Primitive money existed long before large-scale trade networks. Money had an even earlier and more important use. It greatly improved the workings of even small barter networks by greatly reducing the need for credit. End quote. So we can see that money naturally emerges. It's just something useful and required in trade, as we learnt earlier. So it wasn't long before we moved from using primitive forms of money to metals, or we gave particular metals the character of money. And this happened for two main reasons. Firstly, scarcity. So at this point in time, the relative difficulty of producing metals meant their supply was unlikely to significantly change in the near future. You're not going to get massively diluted. And also, the durability of metal was superior to things like shells, grains, and beads, which was very important for seafaring trade. And it could also be forged into uniform units. Here we can see the example of minted coins. All of this contributed to significant value placed on metals at the time, giving them, very high density in terms of value, which just contributes to portability. So to better understand this, we kind of need to look at something called a stock to flow ratio. Now, this is very different from the stock to flow pricing models that get thrown around the internet. But stock to flow really just means how much of something is being produced each year in relation to how much already exists. So what's the rate of change at which new units of a monetary good are introduced into the existing supply? So how much is the supply being diluted each year? And obviously that's going to impact price. Here we can look at silver and gold, or the ratio between those two things over time. So how many ounces of silver to 1 ounce of gold. I just took a few random dates or points in time going all the way back to 3200 BC, at the era of the first king of ancient Egypt. We go through ancient Rome, Julius Caesar, all the way to, the US government's Coinage Act of 1792, which actually set a ratio at 15 to 1. We go through a couple of world wars, and today we're kind of sitting somewhere around the 84 to 1 ratio. So you can see that the general trend has held, though. Silver's only become less valuable relative to gold, and part of that is due to it becoming more abundant relative to gold. So it's important to understand how hard a money is, and that is the level of difficulty in producing new units relative to other forms of money. So this isn't always a static measure. Technology is constantly advancing and relegating formerly hard monies to easy. So why did we converge on gold? What made it so special? Well, the free market eventually converged on gold due to two key attributes that protected its value reliably over long periods of time and across large parts of the world. First being, it could not be very easily destroyed. You're not going to drop it and break it. It just kind of moves around, right? The next is that it couldn't be synthesized. So the alchemists have existed in all forms at all times, but they've never been successful in synthesizing gold. So where did paper money come from? Well, the first kind of forms of paper money, so money backed by a commodity, that actually was first implemented in China by using, the same silver that was brought by the Spanish, but on a large scale, where paper money was maybe used in a more global context, that was always backed by gold, and that existed because gold would be physically deposited and held in a vault somewhere, and then a paper claim would be issued, where the bearer of that claim could then redeem it and be given that gold. So, trade routes expand, transportation of larger volumes of gold becomes more risky. Paper notes, redeemable for gold, it was kind of a convenient solution, but only where trusted banks existed. So this differs from a promissory note or IOUs, which had been used for centuries before. These paper claims were bearer instruments, so they could be traded and redeemed by anyone. And here's a great quote from Murray Rothbard. Now, in today's age, this is going to seem a bit alien to some of you, but he's kind of explaining what a bank is. And it's very different today, but I'll just read the quote. When a man deposits goods at a warehouse, he is given a receipt and pays the owner of the warehouse a certain sum for his services of storage. He still retains ownership of the property. The owner of the warehouse is simply guarding it for him. When the warehouse receipt is presented, the owner is obligated to restore the good deposited. A warehouse specializing in money is known as a bank. So obviously today that's not the case, where we have banks with reserve requirements of zero, who can lend money into existence. But at a time when we were under a hard money standard or a gold standard, you paid to store your money. You might get paid a fee for lending it out, depending on how much the bank would make on the spread, but that led to severe problems, as we're about to see. And that was kind of the beginning of fractional reserve banking, where say a single unit or say bar of gold was deposited, yet multiple claims would be issued, pertaining to that exact same piece of collateral. So gold storage might come with a fee, but if you allowed the bank or vault to lend it out, they might pay you for the privilege. But if deposits were greater than redemptions, well, banks might be tempted to increase their profits by issuing multiple notes as loans against the same piece of collateral. Obviously, you can see where this is going. It leads to panics or bank runs when there are crises of confidence. Here is a picture from 1932 in New York. And, so banks and vaults are engaging in more brazenly issuing IOUs in excess of the deposits. So even small shocks in the economy could be enough to rattle the confidence of the depositors. And when fears over an institution's solvency begin to circulate, it kind of sets off this race among depositors to withdraw their money, hence the term bank run. So this sudden drain of deposits en masse would kind of expose an institution engaged in excessive leverage through fractional reserve banking. It would kind of expose what they were up to. And that's why you kind of get bank failures. This triggers systematic fears. It dries up liquidity. It brings an entire financial system to a halt at this point in time.